Here's the secret no one in finance wants you to know. Deciding where to invest isn't about picking the best stock or fund, it's about understanding your own psychology and risk tolerance first. This is the moment most people rush, so let's slow it down. Think twice, Tony. All right, imagine our friend, let's call him a guy, a stand-in for all of us, sitting on a bit of extra cash. He's been saving diligently, maybe got a bonus, or just found a few bucks hiding in the couch cushions. Okay, maybe not the couch, but you get the idea. He knows he should invest it because, well, that's what smart people do, right? But then he opens up his phone or his laptop and bam! A million flashing ads, news headlines screaming about next big thing stocks, crypto millionaires and gurus promising untold riches. His buddy Dave just told him about this unbelievable stock tip he got from a guy who knows a guy. His cousin, meanwhile, just bought a second house after crushing it in real estate. Suddenly, that calm, rational decision to invest transforms into a chaotic race to catch up, to not miss out, to be smart and savvy like everyone else seems to be. He feels a pang of FOMO, that dreaded fear of missing out. He starts to wonder if he's being too conservative, too slow. His finger hovers over the buy button, perhaps on a stock he barely understands or a cryptocurrency whose white paper he definitely hasn't read. He's got a lump in his throat, a mix of excitement and anxiety churning in his stomach. And this, my friends, is precisely the moment when most people make decisions they live to regret. This is where we hit pause. Because before you commit your hard-earned money, before you let the noise and the hype dictate your choices, you need a framework. You need a set of decision filters, a mental checklist that helps you understand yourself and what you're truly getting into. So let's slow it down, put on our sensible think twice Tony hats, and walk through some questions that will save you a world of pain and regret. Our first filter, perhaps the most crucial one, is what I call the sleep test. This isn't about market volatility, which is inherent in investing. It's about your personal emotional comfort level. Ask yourself, if I put X amount of money into this investment, will I be able to sleep soundly tonight? Or will I be checking my phone every 5 minutes, refreshing the app, panicking at every tiny dip, and generally driving myself crazy? If the thought of a 10% or even 20% drop in value makes your stomach churn and fills you with dread, then you're likely investing more than your emotional bandwidth can handle. It doesn't matter if some finance guru says it's a safe bet or a guaranteed winner. Your personal peace of mind is paramount. If you can't sleep, you've put too much in, or it's the wrong investment for you. Remember, the goal isn't just to make money, it's to live a good life while making money. Next up, the why test. Before you even think about what to invest in, you absolutely must know why you're investing. Is this money for a down payment on a house next year? Is it for your retirement decades away? Or maybe it's just play money you're willing to lose for a bit of excitement. Each of these whys demands a completely different investment strategy. If you're saving for a house down payment in 12 months, putting that cash into highly volatile stocks or speculative cryptocurrencies is like playing roulette with your future. The market could drop, and suddenly your dream home is out of reach. However, if it's retirement money you won't touch for 30 years, a bit more risk, diversified properly, makes a lot more sense. Clarity on your why is your North Star. Without it, you're just throwing darts in the dark, hoping to hit something. This leads us to the boredom test, or as I like to call it, the understanding test. Most people chase excitement in their investments. They want the shiny new app, the exotic derivative, the meme stock everyone's talking about. But true long-term wealth building is often, frankly, a bit boring. If you can't explain what you're investing in to a reasonably intelligent 10-year-old, you probably don't understand it well enough yourself. Seriously, try it. What does this company do? How does this fund generate returns? If the explanation sounds like jargon soup or requires a PhD in rocket science, maybe, just maybe, it's not the right place for your money. The things that are boring, broad market index funds, diversified ETFs, even simple savings accounts for short-term goals are often the most effective for most people. Don't mistake complexity for sophistication. Often they are opposites in investing. Next, the what-if test. This one is less about how much can I afford to lose and more about how much pain can I endure. Imagine the worst-case scenario for this specific investment. Not just a small dip, but a significant painful drop or even total loss. If that investment goes to zero, what happens to your life? Will you be okay? Will it derail your major life plans? Will you be able to recover financially without undue stress or hardship? This isn't about scaring you away from investing, but about being realistic and building resilience. If a potential loss would genuinely devastate you, then you're taking on too much risk for your current situation. It's a crucial step to align your investments with your true risk capacity, not just your appetite. Moving on to the opportunity test. Every dollar you put into one investment is a dollar you can't put into another. This might seem obvious, but we often get so fixated on a single hot idea that we ignore the perfectly good, even superior alternatives. When you're about to jump into something specific, pause and ask, what am I giving up by choosing this? Are you ignoring your 401k match, which is literally free money? Are you passing up a diversified index fund that gives you exposure to thousands of companies for a single stock you heard about on Reddit? Sometimes the boring choice is the one that prevents the most regret. It's about weighing the what-ifs of what you don't do as much as what you do. Now for the time horizon test. This ties closely with your why, but focuses specifically on when you'll need the money. If you need the money within less than 3 to 5 years, generally speaking, it shouldn't be in volatile assets like stocks. The market is unpredictable in the short term, and you could be forced to sell at a loss just when you need the cash. Think high-yield savings accounts, CDs, or very short-term bonds for those near-term goals. For money you won't touch for 5 to 10 years, a balanced portfolio with a mix of stocks and bonds might be appropriate. And for money you truly won't touch for over 10 years, like retirement savings, you can generally afford to take more risk with a higher allocation to stocks, as you have time to ride out the market's inevitable ups and downs. Aligning your investments with your timeline is paramount for avoiding panic selling and maximizing potential returns. This brings us to the diversification test. You've heard the old saying, don't put all your eggs in one basket. It's a cliche for a reason. It's incredibly true in investing. If our guy Tony put his entire life savings into one stock, even a blue chip one, he'd be exposing himself to immense unnecessary risk. What if that single company has a scandal, or a new competitor, or a product recall? His entire financial future could be jeopardized. Diversification means spreading your money across different asset classes, like stocks and bonds, and within those classes, across different companies, industries, and even geographies. It reduces what's called unsystematic risk, the risk specific to a single company or sector. You don't need to be an expert stock picker. Simple index funds or ETFs can give you broad, instant diversification. It's about making your portfolio robust enough to weather various storms. And finally, the patience test. Investing isn't a get-rich-quick scheme, despite what the internet might tell you. It's a long game, a marathon, not a sprint. Are you prepared to commit your money for the long haul, to ride out the inevitable market downturns without panicking and selling at the worst possible time? Emotional investing, buying high due to FOMO, selling low due to fear, is a surefire way to lose money. Patience is arguably the most undervalued asset an investor can possess. It allows compounding to work its magic, and it saves you from making rash, regretful decisions. If you're constantly looking for the next big thing, if you can't stand to see your portfolio temporarily dip, then you might need to adjust your expectations or your investment choices. So, there you have it. These 8 filters, the sleep test, the why test, the boredom or understanding test, the what-if test, the opportunity test, the time horizon test, the diversification test, and the patience test, are your personal toolkit. They're designed to help you, our friend Tony, navigate the noisy, overwhelming world of investing with clarity and confidence. Investing isn't about being brilliant, it's about being disciplined, self-aware, and a little bit boring in the best possible way. It's about making choices that align with your life, your goals, and your peace of mind. The next time you feel that itch to do something with your money, or that pang of FOMO, remember to slow down. Go through these filters, ask yourself these tough questions, and before that decision turns into a regret, think twice, Tony. What's your biggest think twice Tony moment or money mistake you avoided? Let me know in the comments below. If you found this helpful, hit that like button, subscribe for more calm, rational finance advice, and share it with someone who needs to hear it. Thanks for watching, and I'll catch you in the next one.